Hi everyone, welcome to LCG's weekly webinar. So let's, before this, let's first start looking at the risk warning. So this is İpek Özkardeskaya. I'm Senior Analyst at London Capital Group. So please, before we start, make sure that you read the risk warning. So the information and comments provided here under no circumstances are to be considered an offer or solicitation to invest, and nothing here should be construed as investment advice. The information provided is believed to be accurate at date the information is produced, and losses can exceed deposits. So let's move on. This week we are going to talk about the big themes of the week, of course. So the economic calendar is going to be light. The central bank's meeting minutes are going to be the main focus of the week. There's going to be the UK budget statement on Wednesday. We're going to look at what could come out of that and how could that affect the pound markets. The Brexit is still very much on the headlines. We are going to see what's happening on that on the Brexit talks, and we had some good news this morning. So we're just going to talk briefly about that. The US tax reforms, the German coalition talks failed. So that was one of the biggest headlines this morning. So let's start with the RBA. So we know that the Australian dollar has been falling since weeks now, and that was basically due to the fact that the Australian yields are going lower and faster than the US yields or the Japanese yields, so the carry traders are retracting from the market. The RBA, so the Reserve Bank of Australia, is also having concerns about the interest rates. Actually, they do not want to raise interest rates because they have concerns with high household debt in order to prevent any negative impact of higher rates on household debt. The RBA is willing to keep its rates unchanged for a longer period of time. This is what makes the RBA accommodative, and this is basically why we do not expect or price in any rate hikes in the foreseeable future, and that's actually what the RBA is going to reiterate at this week's at the last week's meeting, last time meeting, and that's what we expect to hear or see in the meeting minutes. For the Fed, it's pretty much the same thing. So the Fed said that the Fed didn't hike rates at last meeting, and it wasn't expected, and the Fed is expected to hike rates on December meeting. And I'm just going to check the probabilities. So the probability of the Fed hiking rates in December is 92.3% at the moment. It's priced in at 92%, which means that it's pretty much priced in as a done deal. So we know that Janet Yellen is going to be is no longer going to be the Fed chair from February. Powell is going to take her place. We are expecting to have some continuation trade in the Fed policy because Powell is Jerome Powell, so the new Fed chair is also a dovish member, and he will be willing to keep the interest rate low, but he cannot keep them super low either because he needs to coordinate with what's going on in the economy, the inflation, and that's going to be pretty much a continuation of Janet Yellen's Fed policy. On Thursday, we are going to look at the European Central Bank minutes. So we know that European Central Bank minutes may not give out many surprises, so some expect that some policymakers may have refrained from talking about tapering, but that does not mean that ECB is going to change its plans. The ECB will start tapering its quantitative easing program starting from January. They will be buying, instead of 60 billion euros worth of sovereign bonds, they will be buying 30 billion euros worth of sovereign bonds. So that means that the tapering starts. The ECB doesn't want to call it tapering because that will continue until September, and it's not expected to stop abruptly. This brings me to remind you that the ECB is preparing to stay dovish because they also say that the interest rates are going to stay at low levels way after the end of the quantitative easing program, and we do not know when the quantitative easing program is going to end, and that's what makes the ECB very much dovish, so we don't expect any surprises on that end. What is affecting the euro this morning is mostly the German coalition talks failure. So German German Chancellor Angela Merkel just failed to form a government, a coalition government, and that means that there are uncertainties on the political end in Germany. So the Eurozone's growth engine, and that's causing a bit of weakness in the euro dollar today. So the euro dollar fell all the way down to 117.22 in the weekly open. So now we rebounded on to 118 levels, but there is some resistance at that level, and especially the DAX started the week low. It rebounded until 13,000 level, but it just couldn't make it higher, and now we are back down to 12,962 level. So there is some uncertainties going on the German side, and the Bloomberg news were also suggesting that Germany could need a new election. So this is causing some volatility in the euro markets today. When we look at the Brexit talks, the UK Chancellor Hammond said that the UK may be ready to pay more for the Brexit exit deal, so the divorce bill, so that the negotiations with the EU could move on, because it's exactly what causes the impasse between the EU and the Britain. The EU wants the Britain to pay a big Brexit deal, and the Britain so far was not ready to pay more than $20 billion, and that could go all the way up to $40 billion, according to the Financial Times. And this is why we see a rebound in the pound this morning, and that's very important, because the Brexit is exactly what is causing the market volatility, and that's exactly what pound traders should be watching throughout this week. Of course, with the again, with the budget is going to be important. So the UK budget is on Wednesday, so Hammond is going to give a very cautious budget statement, so that's the main expectation. The reason for this is that we don't know how much the Brexit deal, the Brexit bill costs Britain, and under these circumstances, there are probably not going to be any surprises, any major surprises, or any fiscal gifts at Wednesday's statement. And what does that mean? That means that if the fiscal policy remains steady, then the Bank of England could also remain steady on its own policy, so it could stay dovish, and that means that rates are going to stay low for a longer period of time, and that basically means that the pound should not be affected massively if we do not have any surprises from the UK budget, because the market is pricing in a no change, a cautious view due to the Brexit situation. Finally, the US tax reforms are very important. The expectations of massive tax cuts, corporate tax cuts in the US, is the main responsible of the rally that we have seen in the US stock markets, and the rally is still going on. So we have seen that on Friday, the US markets closed lower, so the Dow Jones was low by 0.43%, and the S&P 500 closed 0.26% lower. So we are going to see what happens with the US tax reforms. We remind that on Wednesday it's going to be Thanksgiving holiday in the US, and there's probably not going to be any major progress until after Thanksgiving. So this week, what are we going to be watching besides the big theme? So the stocks started falling from the tops. So will the downside correction continues? That's going to be important. So Nikkei was the trigger of the global stocks unwind. 2 weeks ago, it started on Friday, and we have seen that there is some uncertainty in the stock markets after the stocks rallied by 20%, for example, the US stocks since last November. So basically, we are going to see if we can see a correction. It's finally time to see some correction, or stock traders are still very eager to jump and they would love to buy the dips, and they would love to see this rally running further. The US yields failed to pick up momentum, so we are back down to 233 level this morning. So the 230 level is the 230% level is the critical level, and it's the 200-day moving average basically, and it may be at risk. If that's at risk, that we could look at the gold markets and see what could be the impact of lower US yields on the gold market. So that's going to be positive, but we are going to move on to the charts very shortly. Finally, the Australian dollar is losing momentum. We said that the yield spread now narrows. The 2-year yield spread something like 5 to 6 basis points right now. From it was basically by 20 basis points 2 months earlier. So one of the major reasons why traders want to invest, take long positions in the Aussies, because they are benefiting from a preferential rate differential. But if the rate differential goes lower, then the carry traders have no reason left to go into the Aussie. So the Aussie is losing support from carry traders, and that's actually waiting on the Aussie. We are going to see the technicals in about a minute. And finally, we are going to have some November flash PMI figures in Japan, the US, and the Eurozone. That's going to be important to see how the activity is running in these big major economies. And obviously, a positive number is going to be positive for the currencies, and negative number is going to be negative impact on the currency. So if you want more details on the weekly events, please, I invite you to watch the LCG week ahead video on YouTube for more details. So let's move on with the charts. So this is my LCG trader. So let's start with euro dollar. So basically, the euro dollar, I'm going to take the hourly chart right now. The reason why the euro dollar went all the way down at the open was, once again, the coalition talks failed in Germany, and that creates an uncertainty in the Germans' most solid economy, let's say, and in the Eurozone's growth engines, most solid economy. And the uncertainties would mean that we could see a second election in Germany. So that what caused all this sell-off. And then as soon as the European traders jumped in, we saw that all the losses have been paired, and now we are basically at 117.91 level. Where could we go from now? So as the market absorbed the first shock, the news will be important. So investors will be watching news from Germany very attentively. But that does not mean that it's going to be that they will continue pricing in actively the first shock. So we could expect an upside correction from here. So this is the hourly chart. So on my charts, normally the red line is going to be the 200-hour moving average. The yellow line is the 100-day moving average, and the blue line is going to be 50-hour moving average. So we can see that the euro dollar went shortly below the 100-hour moving average, and it went higher. So we could expect that the 100-hour moving average could be an interesting dip buying opportunity. So it's 117.80 levels, or 117.80 levels could be interesting levels for the dip buyers who would like to take advantage of the correction after the euro dollar tanked on news this morning. So let's see I'm going to go on the daily chart, so we can see that the trend in euro dollar has been positive since the beginning of November, since we hit 115.54 level. So this move was due to the fact that the ECB announced a quantitative easing, an easing in the quantitative easing, which has been perceived as dovish, and then we stopped here as 115.54 level. If I go a little bit further, my key level was the 38.2% retracement on all the way from April to September rise this year. So 115.09 level is the level which is going to distinguish between the midterm bearish, or long-term, you can also say, a midterm bearish reversal from a rebound. So what happened is that we have seen a rebound, and now we are in a positive consolidation zone here. So if we do, so we have to make an abstraction of this line, because this has been due to the news. We can see that the 38.2% here, so the 117.43 level, is basically key for this positive trend to continue developing higher. So my first level, so my intraday level for dip buying opportunities would be, as we said, 117.80, which was represented by the 100-day moving average. And then if you look a little bit further down the week, the 38.2% level, Fibonacci retracement level here, 117.45 could be an interesting buy the dip level for all those looking at a higher correction in the euro dollar. What could cause a higher correction in the euro dollar? Well, first of all, the US dollar could go lower. Why would the US dollar go lower? So we know that the Fed is going to increase the rates in December, so that's almost fully priced in, and there is that actually gives the Fed or the US dollar a very limited potential on the upside because it has already been priced in. So any news in the US dollar side has more potential to impact the US dollar downwards than upwards. So this is basically one of the reasons which could justify a continuation in the euro dollar's positive trend that has been developing since November 4th here. And as we said again, the 38.2% retracement level is going to be interesting level to watch, and it also coincides with the 50-day moving average. So 117.50, 45.50 level are going to be important. Another reason which would help the euro to gain more momentum could be the European Central Bank meeting minutes. So if the minutes are perceived as more hawkish than expected, then the euro can gain some more upside momentum. But the problem with the euro is that for the moment the yields are going very low, are low, which means that when the yields are low, investors have less interest in staying long or hold the euros because they are not gaining enough interest by holding the euros. And today we can see that the yields are still going lower, and we need the euro dollar to pick up momentum in order to keep on this positive. In order to keep on running through this the positive trend, because if there is lack of momentum, then investors will be stepping out of the euro, out of the single currency, and that's going to be causing some downside correction. So that's very important to watch. The euro needs momentum in order to rally higher. And the news as we had today are very bad for the upside momentum. So we just make sure that you're watching the euro's momentum when you are taking a long position. So again, the 118.60 level here is the first resistance, and then I have 118.86, which is the 61.8% retracement on this September-November pullback. If we go above this level, then that's going to mean that there's going to be a second confirmation of a positive rebound about the 118.86 level, and that could actually mean that the euro dollar is ready to gain more momentum. Let's go on the pound. So this is what's happening in the pound market right now. So today we see this big rally. So that's basically because Mr. Hammond said that he is ready to pay twice as much as what they have said they would pay before. So that was basically 20 billion pounds. So according to FT, if the UK government doubles it up, so 40 billion pounds, that could approach the amount that the EU leaders would like to see the UK paying in order to step out of the European Union and be able to negotiate a Brexit deal after the Brexit. So that's the main problem that everybody knows. I guess businesses are a bit skeptical about what would happen. So basically, we are not sure that 40 billion pounds would be enough to convince the EU leaders to keep on, to continue to move on with the negotiations. What the UK wants is to see how or what kind of deals they could get after the trade after the Brexit happens. So why is that important for the pound? Because the pound, so the European Union is the UK's biggest trading partner. So basically, pretty much 50% of the UK's trade is being done with the European Union. So if there is a problem with the trading relationship, then it could have a negative impact on the pound, because the UK imports in huge amounts of food, goods, and goods from the European Union, and if there is some blockage on importing or exporting, if the European Union countries block the British goods after the Brexit due to a no deal, then it could impact the Britain's trade balance, and it could have a negative impact. So this is basically what traders price in when they hear that if there's a no deal, then the pound tends to go lower. If there is a possibility or a higher possibility of making a deal, then the pound normally tends to go higher. So this is why we are seeing this rally today. This rally, where could it go? So we know that there are some offers at 132. 80, 133 levels. Above these levels, it's going to be, we could see some top sellers going into the market, joining the market, and be a resistance to this upside move. If you look a little bit, zoom out, we can see that the 133.50 level could be an appropriate level for those who are looking to play the correction of this positive move, which has been developing since the beginning of November. So 133.50 level is the level to watch if we go above the 132.80 level. So what's important here is, again, with the same technical approach, we can see that we had a pullback from September to October here, and in order to have a bullish reversal from a technical point of view, we need to go significantly above this 38.2% retracement level, which is at 132.78. So if you go above this level that we are testing right now, the next level to watch is going to be 133.50. And again, the intermediate resistance is eyed at 132.80. So that's intraday and 133 levels. And again, 133.50 levels could be interesting opportunity to selling the top of this game, simply because the uncertainties are still there, and there may not be any deal or any agreements between the EU and the British leaders following the UK's decision to accept to pay more. Let's look at what's happening in the USD JPY. So the fact that the US dollar can't pick up momentum, the fact that the US yields are staying low or sliding towards the 230 level is not good at all for the USD JPY, because USD JPY wants the improved US yields, and once you see that there's a big parallel between the USD JPY and then US 10-year yields, as US 10-year yields goes to 230%, you can see that the USD JPY is also going lower. So now we are at daily chart. So this is my Ichimoku cloud, and we are now for the first time since a while inside the Ichimoku cloud top, and it looks like the USD JPY traders are not willing to go above this level of which has been once the top level, which is 112.35 today. The USD JPY is being sees resistance at just before this level. So what can happen? So the downside momentum can continue. Of course, now we are approaching the end of the year. If the risk sentiment is not very positive, so the investors are moving back to yen, which is considered as a safe haven currency. And if the risk sentiment remains limited, if the US dollar fails to pick up momentum, if the US yields continue moving lower, which is also a sign of a risk off market, then we could expect the USD JPY to continue falling towards the 200-day moving average here, which is at 111.45 level. So what's important is, again, my 38.2% Fibonacci level, which has been tested twice since Friday. So if you go below the 111.91, then this move could extend all the way down to 111.45 and 111, which is a 50% retracement. Buying opportunities could be interesting here and here, depending on the news flow and how the US dollar shapes up following the Thanksgiving. What we can expect from the Japanese yen is, so the BOJ stays very dovish, the Fed is more hawkish, but all that being priced in, the USD JPY needs the US yields to improve, and this is not what we see right now. If the USD JPY successfully holds ground at 111.90 level, however, we could expect to see a upside correction and come all the way back to this Bollinger Band mid-line, which is 113.35, 113.40 levels, which could be quite safe for a sideways consolidation for the USD JPY before a new piece of information comes in and changes or gives a fresh direction to the pair. For the Aussie dollar, so the Aussie is not doing fine. We said it before. The main reason is the fact that the rate differential between the Australian yields and the US yields are narrowing significantly, and that actually keeps the carry traders away from the Australian dollar, where they do not benefit from rate differential, but they consider that they are taking the risk of the Aussie, so they do not want to take the risk of Aussie. So this is why we see that the Aussie dollar is now edging all the way down here, the lower Bollinger Band on daily basis. What can happen with this move? So actually, the next natural target for the Aussie dollar bears is 0.75 level, which is pretty much here. So it's not very far away. So that's the best main level to watch, and the RBA minutes could actually help the Aussie dollar moving even lower if the RBA sounds too dovish. But we know that the dovishness from the RBA is already priced in. So what traders should be looking at also is iron ore prices are a very good indication for those who trade Australian dollar. You make sure that if the iron ore prices are going higher, don't go short on the Aussie. If the iron ore prices go higher, don't go short. If they are going lower, don't go long, because they have a very there is a very significant parallel between the iron ore prices and the Australian prices, at least at the intraday level of the sentiment. So I would recommend to check the iron ore levels to see if it's a good idea to go short that day, or would the downside potential of the Aussie would be limited by a rebound in iron ore prices. In that case, I would wait a couple of more days in order to take advantage of a top selling opportunity. So for top selling opportunities in the intraday chart, let's see what levels are interesting. So the first level that comes here is this yellow line, which is the 100-hour moving average, which has actually acted as resistance since last week. So we could consider that if you are, so iron ore prices were positive today, if we are not seeing any downside move, or we see that the potential on the downside could be limited during the intraday trading, then some traders could wait until there is a correction up until or close to 100-hour moving average level here, which is 175.85. So you can just consider before 170. So between 175.80, 175.85 would be interesting to take maybe a sell position if you are looking for a further Aussie depreciation due to the fact that due to the narrowing yields and the dovish RBA, and again 0.75 level could be a midterm target. We could expect to see some midterm support, some intermediate support here at this level, which is 175.35, which has been the last week's support level. Finally, let's look at gold. So gold is very interesting because it has been, you can see that, so the Bollinger Bands are very interesting to give you an idea on the volatility in this market. And if you see that the Bollinger Bands, so upper and lower Bollinger Bands, start moving away from the midband, that means that the volatility is high. If you see that all these lines are getting close together, that means that the volatility in the market is quite low. So what we see is that the volatility in the gold market has been quite low over the past couple of weeks, and now the gold is moving above its upper Bollinger Band, and that's basically comes down to the US yields, which are moving closer to 30%. So why yields are important for the gold traders? Because the gold doesn't bear interest rates, and when there are improved yields elsewhere, some investors prefer moving to these assets in order to take advantage of improved or better interest rates instead of holding gold, which doesn't bear any interest. And that's basically why when the yields go lower, then the incentive to buy gold goes higher. So with the US yields sliding below 233% level today, we could see that the gold market has been quite bullish before this, so the 12.95 has been tested. If the US yields continue sliding lower, so to 30 level, so we could see actually a further move from the 1300 level. So the only problem is that as volatility is not too high, then if so, given that the volatility is not too high, that means that the potential on the upside and the potential on the downside could be limited, especially if you're looking at if you like looking at the historical data. Of course, you're not looking at big surprises. So if you're looking at where the market is today in terms of gold trading, so the volatility is low. So this is why we can see a resistance at 1300 level. And if there is not major news or a major risk off, then the 1300 level could be interesting for many traders, many intraday traders, to take a short position and expect the gold prices to come back towards the mid Bollinger Band, which is 1278 level. Again, if there is not major news, what kind of major news we can have? So North Korea crisis has been a major news, for example, or any geopolitical crisis could be a major news. The fact that the US yields slide below to 30%, the 200-day moving averages could be major news, but that actually wouldn't pull the prices of the gold lower, but rather higher. But then if we see a rebound, for example, in the US yields, and that could actually cause a downside correction in the gold levels. And again, if I look at this chart, a downside correction target would be a plausible target for those who are looking for a downside correction after this breakout above the Bollinger Band. The upper Bollinger Band could be 1278 level. Again, with the same logic, we can see that some support is going to be, we should definitely come into play at $1265 levels here, which is the combination of the lower Bollinger Band and the 200-day moving average. Finally, I'm going to look at the oil chart. So we can see that this has been, so the rally in oil has been caused by the speculations that the OPEC would extend its production cuts further down the road. So the deadline is March 2017, and OPEC may increase the may delay the production cuts or extend the production cuts until September 2017. That's the earliest, and that's already priced in by the markets. And this is actually what's causing some resistance in the market. So this has been priced in, so the extension of the OPEC cuts. So whatever OPEC says from now on is not going to be taking into account if there is not a big surprise. Can OPEC surprise? Of course they can surprise, but the potential of a higher surprise is very low, and we know that there are some tactical sellers at $58 to $60 levels on the WTI crude here. On the other hand, if you look towards the downside, the $55 level has been a nice entry position for those who just didn't want to bet for a deeper downside correction on oil prices while we are moving into an OPEC meeting, and OPEC and its allies seem to be very eager on keeping the supply side of the markets tight in order to keep to sustain the prices in the oil market. So if you're looking at a directional move, then those who are looking for directional move, again, you need to look carefully at the 55 and the 58 levels up here. Below the 55 level, the downside move could extend all the way down to 53.35 level here. So this is the Fibonacci 38.2% retracement, and that level should distinguish between a deeper downside correction or a bullish consolidation on this positive trend for a retest of the $55 to $60 level. Again, the $55 to $60 level are right now seen as interesting top selling opportunities due to the fact that the upside potential could not be super large because all the information has already been priced in. So this is all. So let's thank you for attending this webinar. You can follow Jasper and I on Twitter. So I am İpek Oskar Deşkaya. Please do not forget to watch our LCG week ahead video, which has all the details and information about what we are watching through this week and how the information or the economic calendar or the corporate events could affect the pricing in the markets. Good luck trading.